Okay, friends, hope you remember what we discussed yesterday, right? Capital structure theories, right? I have given you all the things step by step, the viewpoint, the assumptions, the implications, right? Practical explanation with the help of curves. Is your book complete? Okay, good, big thumbs up from few people, and some people are ignoring. What happened? Kukal, not yet written. Completed the notebook. Okay, great, great, fine. So today one more such session is going to be there, right? So you remember yesterday's setup. We drew the chart and we asked a question to ourselves. That does capital structure? Okay, let me check. Have I started recording? Online, right? Dot. Yeah. Good morning, everyone. Good morning, people. So, see, when yesterday we started the discussion, we first asked ourselves that does capital structure affect EPS? Yes, it affects. That comes in the earlier part. Then we said, okay, does capital structure affect KO? And then we have a varying answer. We did not have one standard answer. What we noted, yes, sir. Some say yes and some say no. Right? Those who say yes, we said, okay, fine. You be there in that group where we call it variable KO theories. Those who said no. Capital structure does not affect KO. KO remains constant irrespective of the capital structure. Other group, constant. Correct? In the variable theory, variable KOs, yesterday we did discuss about net income approach and traditional approach, right? And for the constant KO, we did discuss about net operating income approach, NOI approach, right? In fact, yesterday we ended the lecture on this note. Let's see if it's a constant KO. Modigliani Miller is not going to say something else. Modigliani Miller is also following the same thing. Okay. When we talk about net income approach, we have something like this. KO slides down as you go on adding more and more debt. Okay. When we talk about traditional approach, initially it goes down, then it starts rising up. Okay. But if KO is constant, then it is to be drawn like this throughout. Then what different thing MM are going to do? Modigliani Miller are not going to say something different. They are going to say the same thing. So guys, Modigliani Miller are not into proving KO constant KO approach. Rather, they use that constant KO approach and prove something else. Okay, they show some another. See, you must have understood that all these theories that we learned yesterday, they are the different behavioral patterns of the equity shareholders. Don't you think so? All the theories that we discussed yesterday, they're the different behavioral patterns of the shareholders. Now the same thing, guys, same thing. One more behavioral pattern, okay, is nothing but showed by Modigliani Miller, right? So before we start with that, see, see, see this. This is classwork 20. Yesterday we did it, right? Remember what we discussed? See, we are using NOI approach. KO is constant. So value of the firm is EBIT upon KO. What we had written as per the NOI approach, KO is constant. Okay. Also, EBIT remains same irrespective of the capital structure. So value of the firm remains same irrespective of what capital structure. Correct? You know why I'm taking you back to this question? Why am I taking you back to this question? This is something really very important to understand in the Modigliani-Miller approach, because Modigliani-Miller approach is nothing but NOI approach. They are tapping on NOI approach only. So what they are telling that in the long run, what happens? The value of the firm remains same. Okay, right? So now we will go back to, rather we will talk about today's agenda, that is Modigliani-Miller approach. Okay, and what he is explaining us, he's explaining us arbitrage concept. Okay. Friends, once again, let me tell you, whatever you did yesterday, same process happens today. Okay, you understood what I said? What? Relax. Just listen to me. Now, just listen to me. Always includes eating breakfast, having food, having tea, coffee, zero worries. But hurriedly writing something, no, not that. Okay, calm, keep calm and listen to me. Keep calm and listen to me. Okay, fine. Let's talk about Modigliani-Miller model and let's talk about arbitrage concept. Right? I hope I'm very clear that you're not going to write anything right now. You're going to listen to me, take the screenshots, and copy those things at a little later stage. Is that clear to you all guys? Yeah. Okay. Fine. So let's start. Yeah. See. So Modigliani-Miller model, that is arbitrage concept. Arbitrage. Okay. Let me tell you about arbitrage first. See what happens in general. Not talking about Modigliani-Miller. What is arbitrage? You know what happens? So sometimes in two markets, because of timing difference, because of transportation difficulties, price of the same commodity is different. Okay, so the people who are aware of this thing can use the knowledge, buy from the market with a lower price, sell in the market with a higher price, right? Okay. This is tapping on this gap is arbitrage, right? See, it happens, guys. It happens, right? Many times it happens, right? People like see what people have some production or some they are staying in some rural areas and they have basic some simple farm produce who nobody values. Okay, but when it is packed, bought to the market, then people are ready to pay money for it. So you know what? I don't know the name for that fruit. In my native place now, there is some small black fruit that grows on trees. Normally, the people who take their ships for roaming around and for eating, they eat. So we side them up and we also pick up. They are very sweet. So we eat those fruits. If we are not eating, the sheep are eating. It grows abundantly. So no value. But the same thing when it is brought, packed up and brought, no, people purchase it. People pay for it. See, at one place it is cheaper, at the other place it is costlier. Tapping on that difference is arbitrage. So let's go further now with reference to share prices. What is this or arbitrage about? Let's understand. Okay, first of all, see, MM believe in what constant KO approach. So they are not targeting or marketing anything else. They are followers of constant KO approach. They have favored NOI approach, right? They say we surrender to your NOI approach. We follow you. We respect you. Okay, so what? They also mean the same thing that whatsoever is a capital structure, whatsoever is a capital structure, KO remains constant. So according to MM, KO of the firm remains constant irrespective of the capital structure. Okay. Also, EBIT is not affected by capital structure. Right. Now here I would like to remind you what we just read in question number 20. I think this point we have just read in question number 20. Value of the firm remains, right? EBIT upon KO. Out of that, KO is constant as per NOI approach, and EBIT is as such constant, right? So see, the same thing is happening, guys, right? KO is constant irrespective of capital structure, and EBIT is as such not affected by capital structure, right? I would also say over here, before class work question 20. Okay. So, as per the general formula, KO is what? EBIT upon V. Out of this, EBIT is constant, KO is also constant. So what is going to happen, guys? EBIT constant, KO constant. So what? Value of the firm is also what? Constant. MM, explain a scenario. Okay, fine. Are you okay till here? Because they believe in NOI approach, KO is going to remain constant. And capital structure, irrespective of capital structure, EBIT is always constant. So if EBIT is same, KO is same, value is bound to be same only. Right. Okay. Okay. So MM explain a scenario where two firms are alike in all aspects except in their capital structure and market value. Okay. So they are. So MM explain a scenario where two firms are alike in all aspects except in what? Their capital structure and what? Market value. Fine. So investors will develop a tendency to sell the shares of what? Overvalued firm and buy the shares of what? Undervalued firm. Okay. Ideally, what should happen? Ideally, the value of the firm, if there are two firms alike in all aspects, except in their capital structure and market value, what tendency people will develop? See, people will sell out the overvalued firm when the value is excessively high and purchase something which is undervalued. Undervalued means something which is cheaper, right? You remember a question of the Gordon approach where we had calculated the value of the share. Equilibrium value of the share is what? 48 rupees. And it was valued at 36 rupees. So we said, yeah, this is undervalued, time to purchase. This is undervalued, time to purchase. Okay. So see what has happened, what is going to happen. The investors will develop a tendency to sell the shares of what? Overvalued firm and buy the shares of what? Undervalued firm. Okay. What will happen because of that? Overvalued firm. See, this is the equilibrium line. This is the overvalued firm. This is the undervalued firm. When people will sell the shares of overvalued firm, what will happen? Overvalued firms shares getting sold, value starts falling, as you can see over here. Value starts falling. Right? Undervalued firm, right? What happens? People start buying. Shares are bought. Value starts what? Rising. So overvalued firm value starts falling, right? It is overvalued. And people find this as an opportunity. People are buying what? Undervalued shares. Overvalued firms, value start falling. Or undervalued firms, value start rising. But at one point it will become constant and people will lose this arbitrage opportunity. See, equilibrium will arrive over here. At this line, what will happen? Equilibrium will arrive where value of both the firms become same. Right? What is that? That is buying and selling stops. Did you understand what I said? How it happens, that we will discuss a little later. But this is a basic thing that people are always in search of some buying opportunity, some good buying opportunity. Right? So now that there is a difference in the valuation, what people will do? People will sell the overvalued shares and purchase what? The undervalued shares. You start selling the overvalued shares. What will happen, guys, because of that? There will be a selling pressure, which will do what? Reduce its value. And you start buying something which is undervalued. You start buying. There will be a buying pressure. Because of that, what will happen? The value will start rising. At one level, what will happen? Now see, this is arbitrage only. People see this as an opportunity. This is arbitrage only, right? People are selling something which is overvalued and buying something which is undervalued. But see, this will this remain for lifelong? Will this remain for lifelong? See, as you are a smart investor, there will be many other smart investors in the country. As you can see this opportunity, there will be some other people also who see this opportunity. So many people like you will start selling the shares and will start buying the shares. What will happen? You oversell a particular commodity, the price comes down. You sell, you go on buying, the price starts rising. So ultimately, at one juncture, what will happen? Will be an equilibrium, and this opportunity of buying and selling will go away, right? That will be what the equilibrium value. So what Modigliani Miller are actually doing, they're explaining you this concept of arbitrage in the share market. Okay. So now see, to understand their concept, see, first of all, you should understand this, that they are going to locate two firms. One is overvalued, one is what? Undervalued. That's what they are going to locate, right? Then you should have smart people like this also, no? Who can locate a overvalued firm and who can locate a undervalued firm and start buying and selling. Other people, you should have this kind of knowledge in the market also, right? Okay, fine. I understand all this process, but I'm not willing. See, hello, start your lecture. Lecture will get over somewhere around 10 o'clock. Today is what? Today is anyway Saturday. Market is closed, but the day market is open. Okay, 6:30 to 9:30. Then talking with students for some time. Then it's quarter to 10. Then 10 o'clock is the next lecture. 9:15 markets open. When do I have a time to open the market and check and make the short-term profits? So I have no intention of doing such thing, right? So first of all, there should be one overvalued firm, one undervalued firm, right? Smart investors should locate this opportunity, right? And smart investors should also be willing to tap on this opportunity, right? Yashes, Yashes, right? It is. Good morning, Yashes. Hi, Yashes. Hi. Good morning, everyone. Those who are at least with video on, people, I need to check know that they don't surrender to my sweet voice. Now, don't tell me that I was so much concentrating by closing the eyes. Hello, everyone. Good. So let's be back to this. Okay. So see, this is basically the idea of Modigliani. Okay. Let's see, they are not developing any new concept. They are saying, okay, we strongly believe what? We strongly believe the NOA approach only. From NOA approach, they are developing the concept of arbitrage. Okay. Once again, see people, what I told you. I should be able to locate this opportunity of making money. First thing. Okay. Second thing, I should be willing to do that. Right. So if everything goes as planned by the investor, then this will happen. Okay, fine. So once again, the same thing that not every investor would be willing to do this. By Sumeshwar. Good, good. It's okay. You keep talking from that side. Right. No? So you tell your mom that you're talking to me. It's okay. See, that's what I told you. At the most, what they will say. Earlier, they were half mad. Now they want full mad. Fine. Complete valuation, right? It's okay. Yeah, people. So let's move a little further now. Okay. See, to prove this process, now again, now Molecular and Miller will always prove their own point, right? So to prove their own point, what they are going to do, right? They have made the following assumptions. Okay, what are those assumptions? See, all general assumptions of capital structure theory, they are already there because they are believing in Inouye approach. They are believing in Inouye approach. So Inouye approach is a capital structure theory. So all assumptions of capital structure theories are already there. Plus what? Okay, plus some extra assumptions. Individual shareholder gets loan at the same rate of interest as that of company. How this will come into practice, that I will teach you. Okay, that means where this concept gets used, that I will discuss with you. But understand, suppose I invest in a company which issues 6% debentures. Means what? Means they are taking loan from me. Now, I say that I invest in debentures. But the company is basically doing what? The company is basically taking loan from me. Right? So 6% rate of interest, they are taking loan from me. I go somewhere in the outside, in the open market, I think of taking loan, even I get it at 6%. Okay, that is a understand. Did you understand the how it will be applied? That I will talk when we talk about the example. But what is the meaning of this? That is clear. That I buy debentures. I repeat, I buy debentures from the company. It's 6% debentures. Okay, means what? I'm investing at 6%. Company is paying me 6% interest. Suppose I, as an individual investor, go to the bank for buying for taking a loan. I also get 6% loan. Right? Understood this? Yeah. So what it says, individual shareholder gets loan at the same rate of interest as that of what company. There is no brokerage. Okay. Then investors are rational and willing to make the arbitrage profit. See, I told you know that both things should be there. You should be able to locate the opportunity also. Second, you should be willing to tap it also. See, I'm not interested in tapping the opportunity. That's a different altogether thing. Correct? Yeah. Uh, A very important assumption. This one, the last one, the fifth one that we are talking about, is very important assumption. See, guys, let's read it first, then I will elaborate. Equity shareholder of a levered company is responsible for the debt of the company. Now, sometimes people don't understand this statement itself. Why equity shareholder should be responsible for debt of the company? We all know that equity shareholder are the ultimate owners of the business. Right? Now, if I buy equity shares of a company, okay, if I buy equity shares of a company, okay, tomorrow if the company becomes loss making, guys, so who will be paid first? I'll be paid first, or the debentures will be paid first? Debentures will be paid first. After paying them, if money is left, I will get something. Right? My claims happens to be the last. As an equity shareholder, my claim happens to be the last claim. Do you understand that? Sure. So see, the moment I'm buying shares of a company, the moment I'm buying equity shares of a company, I'm pretty aware that I'm responsible for all the other debts. If tomorrow there is no money, they will utilize my money and pay out all the liabilities. Is this clear to you guys? Right? Means when I invest in a levered company, the one with a debt, I'm aware that I am having some responsibilities. If I can take those responsibilities, then I will buy equity shares. Otherwise, I will not buy. I'll keep quiet, buy debentures, make some fixed amount of right. Once I get to so what happens? I get used to that responsibility. So basically, I'm taking certain risk and I'm getting certain rewards. Understood? See, this happens in our practical life also. We get used to taking certain risk, right? See, now let us talk about some non-commercial things first. That how we enjoy the risk. Okay, do we enjoy risk? Sometimes yes. Okay, yes, yes. See, you go to some amusement park. Okay, there is some ride. Huh? Nobody is willing to go for the ride. Ride is very terrible. Okay, something like this, like this. What happens? Then some friend pulls you. Come on, let's go, let's go. Literally, he or she literally pulls you. Then you do it for the first time. Your heart is almost out of your mouth, but then you enjoy it. Huh? So you take the risk, you enjoy it. Second time, yeah, one more time. Last time. Not next time. Okay, right? See, uh, extreme. One of the extreme sports is bungee jumping. Okay? I've seen many people go up to the board and come back. And sometimes some people are like, you push me, whatever happens, close the eye and push. You push, you get pushed down, you have that fall, straight away fall. And then you enjoy actually. Then you enjoy gliding in the air. Then once you do it second time, you do it third time. Every time you get the chance, you do it. So you get used to taking a certain level of risk. Okay. Now let's talk about the financial aspect because we'll first talk about some non-financial aspects. So you feel like, right, this is something what is relevant to my life also. Okay. CA course, correct, Akshay. Very true. Very true. Taking certain risk only. Absolutely correct. Okay. Now see, talking about financial aspect. See, taking loan is always a risk, but we get used to it. Okay. When a person takes a first time, see, for example, when I took my first housing loan, it was a restless, indebted for the whole life to the bank. What will happen with me now? Every month I have to pay a certain amount. But then what happens? Over the period of time, you get used to it. And back of the hand, you are saving your money. You're saving some taxes also by making payment of housing loan. And at the same time, one asset is getting created. So you get used to it. Okay, but when I took my first one and then gradually the bank manager became a good friend of mine. So we used to have a chat like this. You see, I'm having this housing loan. I used to tell him upfront, let's see, once I get rid of this, I'm not going to see your face for the whole life, at least in the bank. Right? I'm not going to come to, once I get rid of this tension, I will not see you once again in my whole life. And he used to tell me, let's see what happens when the loan ends. Okay? He used to always tell me, that how a drunkard, in the evening or automatically turns towards to a wine shop. Okay? You will come like that. He said, no ways, no chance. Okay. The day I finished repayment of my housing loan, I collected the papers from the bank and I said, goodbye. Don't want to see you in the branch again. Okay, we are a good friends, we'll meet outside, but I don't want to see as a bank manager from us. He said, okay, let's see what happens. After 3 months, I was back to bank. See now what happened. Used to taking risk, certain amount gets deducted every month. The moment the amount is not getting deducted, you start feeling uneasy. When it gets deducted, that time also you are uneasy. When it is not getting deducted, that time also you are uneasy. Why? Because the money is not getting deducted. House, property is not getting created, tax is not getting saved, and because there is a money, we are just wasting it. We are buying this, we are buying that for no reason. We are partying. The money is not getting saved also. So again, back to the bank. Next one, rule number 2. See, we are used to taking certain kind of risk. This is a very important concept to understand. So what now? After understanding that what we are used to taking risk, now what? Now we talk about what Modiglani Miller has to say. Okay, see. So this is very important assumption, guys. You read Modiglani Miller, you read many books, you will not find this written properly documented. Okay. So understand this assumption. If you understand, then the theory becomes easy. See, equity shareholder of levered company is responsible for debt of the company. Thus, he is used to that kind of risk taking. Okay, fine. Now, even if he shifts his holding to unlevered company, now unlevered company means no debt, no risk. But if there is a no risk, obviously the rewards will come down. So what he will do, see, to maintain the level of risk and obviously to maintain the level of returns, he will take proportionate loan from outside and invest in unlevered company. Okay, as an equity shareholder of a levered company, I was having responsibility of debt. Now I become equity shareholder of unlevered company. Oh shit, no responsibilities, no risk. I start feeling restless. Why? Because there is no debt issued by the unlevered company. So no risk, no responsibilities. And the thing is that I am used to taking certain risks. Now what to do? No risk in the unlevered firm, no problem. Go outside the unlevered firm, take loan from the market and take the risk. Welcome the risk. What to do with that money? But invest in unlevered business. You got it? So it's like you top up your risk quotient. As long as you are equity shareholder of a levered company, you are having inbuilt risk. You understand? No? Inbuilt, right? No, inbuilt mic, right? This inbuilt, that inbuilt. Okay. So as long as you are equity shareholder of a levered company, there was an inbuilt risk in the company, right? Now you go for arbitrage, you go for unlevered company. Unlevered company, no risk, no problem. I will go outside and take risk. You getting me? How I will maintain my risk? I'll take that amount of loan from outside, take that risk. Okay, what do I do with the money taken? Obviously, I will invest in unlevered company only, but I will take loan and I will invest in unlevered company to increase my level of risk. And obviously, I know that if I increase the level of risk, proportionately what will happen? The level of rewards will also increase. Understand this, guys. And this is practical. I told you that this happens. You might have not stepped into the corporate world, not started making money, but this is what happens. I told you one simple example of borrowing. Told you now, home loan. First home loan, even you will take some first loan, no, you will get so much tension while taking first loan. But then gradually you will get used to taking this. And then you know that this is the only way of making some savings, making some investments, creating value in the life, commercial value in the life. So this is the fact, this is the practicality. Okay? I hope you have understood this fifth assumption. Okay, fine. So now let's get into the process of arbitrage. Okay, so example, now time to take example. Let us take one example to understand this process. Okay, so we are going to question number 25. First, we will read the question and then we will continue. Okay, let's talk about question number 25. See, there are two companies, N Limited, M Limited, having same EBIT. See, get it, friends? They are same in all aspect except for their capital structure. Means only what? See, the EBIT is same for both the companies. Okay, except what? M Limited is a levered company with a debt of rupees 1 lakh at 7% return. So see, out of these two now, M is what? Levered company. N is what? Unlevered company. Okay. Cost of equity of N is 10%. That of M is 11.50. You have to find the arbitrage process. How arbitrage will happen? How investors will smartly shift their investments from one share to the other share to make money. Okay, remember this question. I'm going to discuss this out at length. Okay, I hope you have notes and you open this question in your notes as well. So let us discuss this question at length. Okay. So let me first just collect all the facts. Okay. See, look, we are talking about M limited, N limited. M limited is levered. M is levered. N is what? Unlevered. Both of them will have same EBIT, 20,000 given in the question. But because M is levered, there will be interest at the rate of 7% of 1 lakh. That is how much? 7,000. Correct, friends? So dividend is how much? 13,000 over here and 20,000 over here. Guys, I hope you remember this. EBIT minus interest as dividend. Yesterday only we have done. Right? Capital structure theories, right? The common formula. So EBIT minus interest is what? Dividend. Okay, fine. So we reached till dividend. Okay. KE is given in the question, right? This is what is given in the question. So how we find equity? It will be dividend upon KE, dividend divided by 0.1150, dividend divided by 0.10, 10% is 0.10. So equity, market value of E, equity E. Therefore, market value of what? Equity. That is E is 113043. You can do it on your calculator right now, guys. So do it now. It confirms. In case suppose I make a typing mistake, then divided by 0.115. Correct? Did you try doing that again? 113043. Right? Okay. 20,000 divided by 0.10 is bound to be what? 2 lakh. Okay, fine. To this, what am I adding? I'm adding debt. So this becomes value of the firm. Now you have your answer over here. See, 2,13,000. No, this is greater, no, guys. Correct. So what I can conclude, I can say that M limited is overvalued. Correct. And N limited is what? Undervalued. Okay, friends, this is point clear to all of you. We reached till the value of the firm. Correct. Value of the firm M is higher and N is lower, right? So we confirm that M limited is overvalued and N limited is undervalued, right? Okay. So now you know, according to Modigliani Miller, how the arbitrage is going to take place. What will happen? The investor one who is having the shares of M limited, what will he do? He'll sell the shares of M and buy the shares of N. Is this point clear to all of you? Right? Okay, fine. Let me write over here. Thus, according to MM, investor will sell shares of M limited and buy shares of N. Correct, friends? Is that clear? Will this happen for the whole life? Huh? Tell me, will this keep happening for the whole life? Then, right? This is what we have discussed over here, right? Selling pressure on overvalued firm, buying pressure on undervalued firm. Gradually, what will happen? Their values will settle down. Okay, fine. So now, I don't want anyone of you to chat in between. Just understand and think like who, not like me. Think like Modigliani Miller to understand their ideas, right? So the chat box is off for some time. Listen to me very carefully. So guys, picture is clear till here. Just confirm like this. Picture is clear till here. I have not got you any arbitrage process. I'm just telling you whatever we have written till now is clear. Our conclusion is understood. Selling the shares of M, buying the shares of N. Okay, fine. Okay. Let's see now how arbitrage process takes place. So we have to make an assumption that somebody at least hold the shares of M Limited, right? So we make an assumption. Okay, fine. Let's say that. Okay. See, M Limited is overvalued. To show the process of arbitrage, let's assume investor Mr. A holds 10% shares of Levered Company. Then we can only prove no that what will he do. Okay, fine. So let's see. So let's analyze his position before arbitrage. Okay. Market value of holdings of Mr. A. 10% equity shares of Levered Company. He's holding 10% shares. We have made an assumption. Somebody has to buy, somebody has to sell. So we are saying when Mr. A is there, he's having 10% shares of M Limited. What is the total market value of equity of M Limited? Can you see on the very first line on the top? Market value of equity of A Limited is how much? 113043. Correct? How much shares Mr. A is holding? 10%. So what will be the market value of his shares? 10% of this 113043. Got it? So see, market value of holdings of Mr. A. 10% of equity of levered firm. Correct? That is 10% of 113043. That comes to how much? 1130.4. Everybody is clear? 1130.4.3. Everybody is clear to this? Okay. Now see, if he's holding 10% equity, then he will enjoy 10% dividends also, na? Or not? So you can see in this chart, what's the total dividend that company is declaring? See the first line. What's the total dividend company is declaring? 13,000. Now, didn't you get it? The first line, 13,000. Huh. So now you tell me, if he holds 10% shares, he will get 10% dividends also. How much? 1,300, 1,300. Correct? Okay, fine. So now, first of all, say, understand this up to here. Before he does arbitrage, this will be his position. He will be holding 10% of the shares whose market value would be this much, 1130.4.3. And because he's holding 10% shares, he will enjoy 10% dividend. Proportion. Okay, first you need to confirm, all of you need to confirm this with me, that did you first of all understand the existing position? How arbitrage will happen, we will talk on the next stage now. This is his position before arbitrage, before doing any dealings. Okay, so according to Modigliani, what we discussed, that this firm is overvalued now. Now he's going to sell the shares and step into what the shares of N Limited. Okay, fine. So before arbitrage, it is his position. 1,300 dividend income, 1130.4.3 value of the shares. Okay, fine. So now he is going to act what MM has told. So MM told him to sell the shares, right? Okay, fine. So let us make him sell these shares. So on arbitrage, first step, as I told you, sell the shares of Levered Company. He sells the shares of Levered Company and he will make how much money from that? He will make 1130.4.3 from that. But then he will start feeling restless. You know why restless? No risk, no responsibilities. He sold the shares of Levered Company, no? He was used to taking some risk. Now he's feeling restless. Why? There is no risk and no fun, no risk, no fun. So how to take that risk now? Take shares from the take loan from the open market and top up your risk. Okay. So earlier you were a 10% shareholder in the Levered Company, right? So you are responsible for total 10% of the debt. How much is the debt in the Levered Company? 1 lakh. How much is the debt in the levered company? 1 lakh. He was 10% shareholder. So 10% risk of the debt, 1 lakh's 10% is how much? 10,000, right? So to top up the risk, what he should do? Take a loan from outside, 10,000. So on arbitrage, you see what is he doing? First, he sell the shares. Second, see, he was 10% shareholder in levered company, therefore responsible for 10% of the debt of levered company. Now, to maintain this risk and the level of rewards, he will take a loan from outside equal to 10% of debt of the levered company. So 10% of 1 lakh loan he will take. So that will come to how much? 10,000. Did you understand this? But by taking this loan, he is not going to party. What will he do? Whatever money he got, oh yes, whatever money he got by selling his shares, plus the money from taking loan, everything where he will invest in unlevered company, in the unlevered company. Did you understand that? So how much money, total money does he have? So total funds available for investments are now this 11,304.3 plus this 10,000, 21,304.3. Total funds available for investment. What will he do with that? From these funds, he will buy shares of N Limited. That is what? That is the unlevered company. Come on, people, tell me, did you understand till here? This aspect, see, this point is very important. The one which is written in slightly orange color. This part is very important. He from levered company, he is shifting his holdings to unlevered company. Unlevered company inherently doesn't have any risk. So to maintain his risk, what is he doing? He's taking loan from outside. Okay, but sir, in this process, how is he benefited? That is important. Now, how is he benefited? Because he should benefit also, no? He's not doing this for a charity. So let's see how is he benefited. See. Okay, let's see his position after arbitration. So he's buying shares worth 21,304.3 of the unlevered company. Okay, let me take you back over here. Unlevered company's total market value of equity is how much? 2 lakh. Correct, friends? Unlevered company's total market value is how much? 2 lakh. And total dividend is how much? 20,000. Okay, fine. Let's come to after arbitration. Okay, see. Proportionate dividend income from Unlimited. Just now we read equity is 2 lakh, dividend is 20,000. How much our smart shareholder, how much is he buying? He's buying 21,304, guys. Right? So what? So he should make proportionate money also, no? He should make proportionate money also. Right? So for 2 lakh, dividend is 20,000. For 21,304.3, how much it will be? I hope you understand. 2 lakhs 20,000 is 10%. So 10% of this, if you don't understand, no problem. You cross multiply 2 lakhs, 20,000 into this divided by 2 lakh. Ultimately reach this figure, guys. So how much? 2130.43 rupees of dividend he will earn. Agree? But now you tell me, he has taken some loan from outside of rupees 10,000. Now he will have to pay the interest also. How much will be the rate of interest? Same as that of company. That's the Modigliani Miller's assumption, right? So when the company who had issued debt, what was the rate of interest? See the line, 7%. The first line, interest 7% of 1 lakh. 7%. Sure, understand that. So he will get that loan of 10,000 even at 7%. So 10,000 7% will come to how much? 10,000 7% will obviously come to 700. So 21,304.43 is what he earned, and 700 is what he will have to share away as interest. Okay, see, I have explained it over here. Assumption: rate of interest will be same as that of the rate of interest for company. So less interest on loan taken, 7% of 10,700. Guys, 2130.43. He earned 700. He lost. Still, what is his net income after arbitrage? His net income after arbitrage is 1430.43. Now, if we look over here, before arbitrage, what was his position? He was earning how much? 1300. So compare it, no, guys. Net income before arbitrage is 1300. So how much is he benefited? He's benefited by 130.43 by doing this arbitrage process. Students say, sir, what so much headache for 130 rupees? It's not like that, guys. It's not like that. We have taken very small amounts. We have taken very small amounts. If we take huge amounts, the amount of benefit will also increase further. Right? So this was just an example with thousands and 10,000s, you are making this much. If you invest in lakhs, 10 lakhs and multiples of that, then obviously the benefit will be more. Okay, let's see the whole solution once again. Let's see the whole solution once again. See, first of all, this is the position, right? M limited is levered, N limited is what? Unlevered. M limited happened to be overvalued over here, correct? And N is undervalued over here. So what is decided? To sell the shares of M limited, to buy the shares of N limited. Okay. First, we clarified that, okay, fine, to prove, I need to have some numbers. So question is not telling me that there is any investor of M limited amount. So I assume that there is one investor having 10% shares of M limited. So what is the first step? We calculated his position before arbitrage, right? So before arbitrage, he is holding 10% shares of M limited, whose market value is 11304.3, and the proportionate dividend is 39. Okay. On arbitrage, what will he do? He will first sell out those 11304.3 of shares, and to maintain his risk level, he will take proportionate loan. So he was 10% shareholder in levered company, responsible for 10% of the total debt. What is the total debt of the company? 1 lakh rupees. As you can see over here, total debt is 1 lakh rupees. So he will take 10% loan of the same amount. So that comes to how much? That comes to 10,000. So he will have 21,304.3 rupees at his disposal, from which he will buy shares of unlevered company. So what will happen after arbitrage? He will earn a dividend of 2130.43, but he will have to shed out the interest of 700 rupees on the loan taken. Still, he will have a positive benefit of how much? 130.4. And see, this is the process how arbitrage has benefited this person. Okay. Did you understand this, guys? Sure. See, for this, you know what? You need to think like a Modigliani Miller. If you develop your own thinking, but sir, what if he doesn't take loan from outside? But sir, how will you find it out? So that Modigliani Miller has written. It has, we have done this concept purely on the assumptions of Modigliani Miller. If you say, sir, why should he take loan from outside? Then you are violating the assumptions of Modigliani Miller. Modigliani Miller is telling you that he will take loan from outside to maintain his level of risk. Right. So means these kind of questions will only deviate you from the concept rather than understanding the concept. So how investor will find this opportunity? It is written by Modigliani that the investor is a smart investor wanting to tap on this arbitrage profits. So is this possible in real life? Yes, possible. 1 in a million smart investor may find this opportunity and may make money. See, if everybody was in position to do this, then this concept would not have remained only secret. It's a trick, na? Right? Sharp at 9:15, I open the market, quickly make some money and come back. I tell you 2 minutes, students, 2 minutes. 2 minutes. Okay, immediately I open the market. Short-term investment opportunity, sell out, make money. Students, I'm back. It's not, that's not that easy. Few people do it, that means it's not impossible. Right? See, take some examples like people dive inside the water without oxygen cylinders. Okay. And you see some people have developed skill that they remain 4 minutes, 5 minutes inside the water. He can't remain, that doesn't mean it cannot happen. Right now. climbing Mount Everest. Is it like, chalo, after the lecture we will go on? Hey, chalo, 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 come on, let's go. Is it that easy? But some people are doing it, na? They are like 1 in a million only, maybe 1 in a 10 million. So few people can tap it, not everybody can tap it. Ah, okay, fine. So let's go to the next one. I don't want anyone to write all this right now. Who's writing? Haripriya is writing now. Haripriya, you're writing. Why? I told you I take photograph later on. Should I make you sit like this for the exam or for my lecture? Or like this? Don't write, people. Don't write. You get some time to write. Okay? See, the only thing is I say I don't tell you always like this. I don't write. Don't write. Somewhere in this process, you lose some points in the discussion. Okay. Not everything is, see, most of the things are written on the paper, but not everything can be written on paper. Something has to come in discussions also. I make sure that almost all the things I tell you, I jot down as a point in my notes. But sometimes it happens. No? Discussion always, no, I cannot write practical example like bungee jumping over here. But then when we discuss, definitely it throws more light on this concept. So that you tend to miss, so I tell you that please don't keep on writing something right now. Okay. Fine. So let's go to one more question based on this. We will go to question number 26. Okay, because I have to show you both possibilities. In the first question that we discussed, that is question number 25, levered form was overvalued, guys. Okay, what was overvalued? Levered form. Let's see question number 26. It's going to be the other way around. Again, there are two companies, U Limited, L Limited. You understand by the name also, right? What must be the scenario? U Limited must be unlevered, and L Limited must be what? Levered. That's what is happening. Okay. Having seen NOI, guys, NOI, net operating income. EBIT. Operating income is what? EBIT, right, people? Ah, okay. So having same EBIT of 20,000, except that L is what? Levered company. That we already concluded, right? That name itself is very clear. With a debt of how much? 1 lakh at 7%. Okay. Cost of equity of U and L is 10 and 80. Okay. So U limited KE is 10, L limited KE is 80. Okay, fine. Show how arbitrage process will work. First of all, see guys, arbitrage process will work provided one company is overvalued, other companies undervalued. Right? Then only that investment opportunity will or short-term profit-making opportunity will come into existence. Correct? Okay. So first, let's see that only that there whether there is such opportunity available. So first we will decide that. See, solution to class 4 question number 26. L limited, as I told you, is levered. U limited is unlevered. EBIT same. I think this part is coming same, right? You should not feel that every time it's just that it is coming same. Interest at 7% of 1 lakh is 7,000. Dividend over here is 13,000 and dividend over here is 20,000. Okay, fine. Guys, this is given. K is given, right? 18%, 10%. So we find equity, the market value of equity. That is what is E, dividend upon K, right? So we do dividend upon K, we get market value of equity. You can check it out, 13,000 divided by 0.18. 72,222.22. And this is 2 lakh by 10%. 2 lakh by 0.10 is 2 lakh. Sorry, 20,000 by 0.10 is 2 lakh. Plus, Levitt company has a debt. Okay, fine. So value of the firm, this is 172,222. This is 2 lakh, guys. Now you know this is overvalued, right? You can see that, correct? What you notice, your unlevered firm is overvalued, right? In the earlier example, what I did, we took the levered firm as overvalued. Now here, what we are taking, unlevered firm as overvalued. So like both examples we are covering, right? Okay, let's see. Again, the process is same. Whatever is overvalued, that you sell off, and whatever is undervalued, that you start buying. Okay. See, like I always think that if I have a property in a city, okay, what I will do, I'll sell it out. It is, and then I will not spend the money, but I will purchase the property in a tier 2 city, which is yet to develop, or it is not equal, but a little lesser. It is started developing, but it is not same as a tier 1 city, the first city. Or I will invest in the native place where where it will start growing after maybe 10 years, 20 years, 30 years. Right? So see, we need to understand this for sure. There's a human mentality that we try to sell out what is overvalued and try to buy what is undervalued. That's our habit. Okay, fine. So here who's overvalued? You limited. Unlevered is overvalued. So the shares of unlevered firm will be sold. So again, we have to have some numbers. So let us assume that there is Mr. B who holds 10% shares of what? Unlevered company. Okay, what he does, he holds what? 10% share of what? Unlevered company. Fine. So again, before arbitrage, stages, right? I think these 3 stages makes it easy. Like what is his position before arbitrage, on arbitrage, and after arbitrage, right? This the way we discussed over here, right? Let me show you quickly, right? We have put the whole solution in 3 parts, right? You can see that before arbitrage, on arbitrage, and what after arbitrage. Correct, friends? We will do the same thing over here. Okay, first of all, let's understand his position before arbitrage. Okay, fine. See, what is his position before arbitrage? Hold and calm. He is going to hold 10% shares of unlevered company. What is the market value of shares of unlevered company? 2 lakh. You can see that. I have kept my cursor over here. 2 lakh. Hello, people. When I keep cursor at a particular place, can you see my cursor? Right now. So you know that I'm pointing this, I'm pointing that. So see this. This is the market value of what? Unlevered company. 2 lakh. And he is holding 10% of that. And what is the dividend? Dividend is 20,000. So let's say this position before arbitrage. Value of shares held 10% of 2 lakh. That will come to 20,000. Now, obviously, we will earn proportionate dividend also. So, total dividend income is still seen on the screen. No? That is how much? 20,000. See here. 20,000 total dividend income. Of that, he will get 10%. So, proportionate dividend income, 10% of 20,000. That will be how much? 2,000. So, guys, this is his position before arbitrage. Suppose he says, I don't want to do anything. This is his position. Correct? But definitely he is interested in making quick profits. Right? He's a smart investor according to who's willing to shift his holdings from overvalued form to undervalued form. In search of what? In search of profits. Okay, so what is he going to do now? He's going to sell these shares because this firm is overvalued, right? He's going to sell these shares. Okay, so let him do that. On arbitrage, what do you see in the very first line? Sell the shares of unlevered company. Guys, by selling these shares of unlevered company worth 20,000, he will make money worth 20,000. You see my cursor over here, right? He will sell the shares of what? Unlevered company. Come on, tell me, people. When I am the holder of unlevered company, when I'm the holder of unlevered company, do I have any inherent risk? I'm the shareholder of unlevered company. Do I have any inherent risk? No, no, I don't have any inherent risk. Okay, but in the process, now I'm shifting to levered company. So if I shift to levered company, inherent risk will always come. Correct. Now see what is the approach. Okay, see. Sell the shares of unlevered company. That is fine. So amount available for investment is 20,000. What was his holding percentage in unlevered company? His holding percentage was 10%. What to do? Buy 10% shares of levered company. See what is the market value of levered company? 72, 222.22, right? Buy 10% of this. Okay, fine. From these, purchase 10% shares of what? Levered company. You can see this amount 7222.22, 10% of this number, right? But now, see, listen, what happens now? Now he knows that he's shifting from unlevered to levered, and levered has an inherent risk. He bought 10% shares of levered company, so he's responsible for 10% debt of the levered company. How much will be the 10%? How much will be 10% debt of levered company? Will it be 10,000? This is a total debt, no? This is a total debt. So 10% of that would be 10,000, correct? I know that I am responsible for 10% of the debt. How do I tackle with it? I have money. I will buy the debentures of the levered company. Matter finish. Whatever is to be invested, I've invested. Tomorrow, if I suffer, I will suffer that 10,000. That's it. Okay. So what am I doing with the available money? See, I had 20,000 at my disposal. Let me go to this step. I had on arbitrage, I sold the shares and I have 20,000. I've already bought from this number one, purchased 10% shares of levered company. I've already done that. Let me buy the debt of 10% debt of the levered company. I bought it. Matter finish. Whatever would have been the probable loss, I've already invested that much money in the company. So I'm responsible. I bought 10% shares also, and I bought 10% debentures also. Okay, how much money I invested? 7222.22 plus 10,000, right? How much total I invested? 17,222.22, correct? How much I have to invest? 20,000 is visible on the screen. So am I left with some money? Yes, obviously, I'm left with some more money to invest. Okay, let's see. So amount still available for investment 2777.78. Come on, guys, did you understand this? Everyone? Sure? Huh? Okay. By selling the shares of unlevered company, I had 20,000 rupees. From that, I bought 10% shares of the levered company, costing 7,222.22. And I bought 10% debt of the levered company for 10,000. I spent a total 17,222.22. So I'm still left with 2,777.78. Okay, but then I just need to see how much is my income. How much is my income by doing this? See, now I am having two holdings. I hold debt of the levered company as well as equity of the levered company. As an equity investor, I'd be entitled to dividend. See, after arbitrage, I bought 10% shares of levered company. What is the total dividend declared by levered company? I'm just placing my cursor on that. Total dividend declared by levered company, 13,000, right, friends? So I will be entitled to 10% of this dividend, correct? So see, after arbitrage, my position, income of Mr. B, proportionate dividend from the equity shares of levered company. See, on 72,000, 22 point total equity. They give 13,000 dividend. I hold 10% of that, so I'll get 10% dividend. Come on, people. Do you all agree with this? That I will earn 1,300. Will that be my only earnings? I bought debentures also. Hello? Shh. I bought debentures also, na? So I should not earn interest income. Excuse me. You agree with? I bought two things of the levered company, right? I bought shares also. I bought debentures also. Okay. So now that I bought debentures, I get interest income from the debentures. I've taken 10,000 loan. So 7% of 10,000, that comes to how much? 700. So what is my total income? 2,000. So benefited or not benefited? Sir, what was your income before arbitrage, sir? Okay. My income before arbitrage was 2,000. Sir, what waste of, sheer waste of time, sir. Here also you are earning 2,000. Huh? And sir, here also you are earning 2,000. What is the point? Sir, you wasted our time. What say, guys? No profit. No profit. Before also 2,000, now also 2,000. Can can I increase my earnings? Do I have some more money left for investment? Yeah, that's the point, guys. Before arbitrage, after arbitrage, you see 2,000 same is okay. But still, I'm left with some money for investment. No, how much is that? I'm left with this amount of money. Amount still available for investment. How much? 2777.78. If I invest this, definitely my earnings will be more than my earlier earnings. Right now, you see it same, correct? But see, the major difference is that the investor is left with what? Investable surplus of 277.78, guys. Right? What he can do, he can always make higher returns by investing this amount. Let him in. Now you'll ask me, sir, where we should invest? Invest anywhere. Invest in levered company, invest in unlevered company, invest in government securities, whichever you are okay with. Unless you put some kerosene on this money and burn it out, wherever you keep it in bank, 4% returns, still your earnings will be higher than 2,000. You understand what I said? So arbitrage is understood in both scenarios. Okay, for 2 minutes only, I'm opening the chat box. If you have understood, please post me. Yes, sir. Understood. Okay. Okay. Done, people. So back to the understanding. So what Modiglani Miller say? So Modiglani Miller says what? That you will find this buying selling opportunity only up to what the value of the firm becomes equal. Short term. Arbitrage is a long term concept or a short term concept? Short term concept, right? In the long run, what should happen? Values of both the firms will become same, and this investment opportunity will be gone. Short term profit making opportunity will be gone. Okay, fine. So now continuing with the concept. So see, as per approach, what? When two companies are identical, what should happen? Their value should become same, right? Equilibrium value will be equal to EBIT upon equilibrium KO, right? So just check question number 22. Let's have a quick look at question number 22. See, they are giving you so much information. Yeah, see, the following are the cost and value of the firm A and B according to the traditional approach. Firm A, Firm B, value, see here. This is 50,000, this is 60,000. You know what is happening, right? It is like this. Correct? Okay. Market value of debt is this much. Market value of equity. So, hello, so listen. This is like this. Did you understand what I said? Printing error, printing error. This should have been over here. Expected net operating income. Expected net operating income. Both companies are same. Right? What is this? EBIT. From EBIT, what we deduct? Cost of debt. That is what? Interest. See, this fellow doesn't have any debt. This fellow has 30,000 of debt. So 30,000 of debt, and then see here, zero interest, 1,800 as interest. Correct? 5,000 minus zero. Do it on your calculator. 5,000. 3,200. 5,000 minus 1,800. 3,200. Guys, according to capital structure theories, EBIT minus interest, what we call it? We call it dividend, sir. Correct? And cost of equity has been given over here, guys. 10%, 10.67%. Hello, people. Here are my people. Is there are you guys listening? Do you understand that this is one line misprint? Okay, fine. Compute the equilibrium value of firm A and that of B in accordance with approach. Assume that taxes do not exist and equilibrium value of KO is 9.0. Okay. So see guys, EBIT is same, right? Understand? Over the long period, what will happen? The value will become same, right? So what we say in general, see, I will tell you this. We say that KO is EBIT upon. So at one place, what is going to happen? The value will become same, right? So ultimately, EBIT upon KO would be constant. So what they have done, they have given it this constant KO 9.09, and EBIT of both the firms is same. So you just have to find this equilibrium value. At what value the arbitrage will stop? Okay, at what value the arbitrage will stop? So very simple question, guys. Very simple question. See what we are going to say. They are asking you at what value the arbitrage will stop, the equilibrium value. So we know that equilibrium value is EBIT upon equilibrium KO. EBIT is what we already know. No, both firms are 5,000, and equilibrium KO given in question is 9.09. Guys, points you convert, this will become 0.0909. Okay, so 5,000 divided by 0.0909, coming to 55,005.5. So see, this is the equilibrium value. What I would say, when both firms have V is equal to 55,005.5, comma, arbitrage process will stop. Is that understood? Okay, fine. I think you are doing a role of silent spectator, because when you write so many things. Okay, yeah. So according to okay, let's do one thing, guys. Let's take 2 minutes break, then we will continue. Keep calm, maintain silence. Okay, nobody's dead. We're not praying for anyone's peaceful life, but because once we assume Modiglani, once we live in keep calm, listen to me carefully. After some time, we'll continue 2-3 minutes. That's it, just to refresh our minds and come back. How many people come back? Hmm. Okay. So, see, everyone out there, no? Yes, people, let's start. Let's start. So, see, ultimately, what MM says. So, MM says that this arbitrage will happen, and in the long run, what is going to happen? The value of the two firms will remain constant if their EBIT is same. Okay. So, according to MM, this is once again, very typical concept. If the taxes do not exist, what he is claiming? He's claiming that value of the levered company will be just the same as what value of the unlevered company. Okay. Value of the levered company will be just the same as what value of the unlevered company. Okay, fine. What? But provided what? If the taxes do not exist. What is the difference that you see over here? See, if the taxes exist, then what he says? He says that, particularly Miller say what? Value of the levered company would be value of the unlevered company plus debt into tax rate. Now, what is this addition? Debt into tax rate is what we need to discuss. Okay, I hope every one of us understand that levered company always enjoys tax benefits. Come on, after learning capital structure, after learning indifference point, uh, after learning KD, where we wrote that interest has to be multiplied by 1 minus T to arrive at effective interest, at least all of us should immediately understand this. But then when we talk about like this, I ask like this, where is the interest paid, above or below? So what is this question? Can you understand my question? Where is the interest expenditure paid, above or below? What is this question? Where? Above. What do you mean to say? This is which line? Tax line. This is a tax line. Where is the interest paid? Above the tax line. Correct. So the moment you pay interest, what happens? You save some tax. And where is the dividend paid? Below the tax. And after tax is paid from the after tax profit. So we have always discussed that, sir, company which is levered no and having interest, having debt in its capital structure is always benefited, sir. Interest cost is reduced to a certain extent. The benefit is interest into 1 minus T, right? Effective interest. So the benefit is, sir, interest into tax rate 40%. Suppose the tax is 40%, then what will happen, guys? If the tax is 40%, whatever interest expenditure I'm paying, of that 40% would be saved. Okay, sir, understood. Did you understand what I said? But then, sir, how the benefit is debt into tax rate? Then if you are saying that the benefit is interest into tax rate, then that benefit should have been interest. The benefit should have been interest into tax rate, benefit of 1 year multiplied by n number of years. What's it, guys? Correct, huh? The benefit should have been like this, no? So debt into tax rate is not justified. Why the benefit? See, what is we are saying in the first line? What we are saying over here? See, if the taxes do not exist, see, if the taxes do not exist, then value of levered company is just going to be equal to what? Value of unlevered company. Only place where levered company will have a merit is when taxes are there. So by how much amount will it be benefited? Sir, every year it will save, which will be equal to interest into tax rate. Correct? Every year that would be the saving. And whatever number of years of loan is there multiplied by n. Sir, this should have been the answer, sir. Why are we writing this over here? In debt into tax rate. Okay, probably see. Once again, I explain my stand over here. Let's see, these all workings are done when? Much before the capital is issued. Understand? See, you remember when it came to in the cost of capital, very starting point, when it came to explaining you perpetual debt, irredeemable debt, everybody was like, sir, debts cannot be irredeemable. Then I had to convince you people, you see, debt is not irredeemable, but it is a point of time when we are discussing on this. Remember, I gave you some example like chartered accountants, articles, they meet at a coffee table, they plan it out, right? You remember what I told that, see, they say, okay, after we complete our chartered accountancy, right? After 3, 4 years, we'll start our business, then we will take loan. Because then we are going to take loan. 1 minute. Yeah. So see, again the same thing happens, guys. Again the same thing happens that we are at much an uncertain level where we don't know what will be the duration of the loan. Okay, so probably MM meant to say that at least the interest which I pay attention, at least the interest which I pay for n number of years should not exceed the value of the debt. Should not exceed what the value of the debt. Then, if you think like that, then the tax rate will come down. Let me write this again. After let me explain the whole thing once again. See, so what we are saying the benefit should have been interest into tax rate. Is the benefit of 1 year multiplied by n. Okay, fine. Now what, guys? See, you don't know what is the duration, but what will ensure that n interest into n, that is the total interest that you pay over the life of the debt, at least should not exceed the value of the debt. Okay, so if we think that way, then this interest into n will become what? So this interest into n itself is now going to become what? Itself is now going to become debt. Okay. See, this logic is very difficult to cope up if you don't understand this. And then into this tax rate as it is. So this is the overall benefit of the levered firm according to their estimations. Hello, people. Understood what I said? Okay. See, if there are no taxes, as you see in the first line, if the taxes do not exist, then there is no such question. But if the taxes exist, at least agree that levered firm will have some advantage in quantifying. Then MM is trying to quantify that advantage. MM is trying to quantify that advantage. And then according to MM, this is advantage. Okay. If you don't like, it's okay. According to MM, this is re, reiterate my words that is according to MM. Right? MM's logic is this: okay, fine, you will not take debt exceeding so much that you don't cross over the value of the debt. So interest over the number of years should not exceed debt is what they think probably. That's why they give this formula. Okay, fine. So now what you do is you'll take the screenshot of this. Which law we have started today, guys? I hope this page's screenshot is taken. Done taking screenshot. Done. No? Okay, see. So I think you should manage to fit in the same length, right? 1, 2, 3, 4, 5, and 6. Okay. Whatever did you? I assume that there is no backlog of yesterday's copy. No backlog. If that holds true, then whatever you have written till now, leave 6 sides. Or you have seen. I always tell you that compare your handwriting with my handwriting. If you feel that you have a handwriting bigger than me, okay, leave more pages. If you have handwriting smaller than me, leave less pages. But then ideally you should complete this within 6 to 7 pages, right? So that is your personal uh, experience that I cannot tell, but leave sufficient space. Done, friends? Okay. So now we are going for the next questions. Okay. Let us start. So we are left with two questions if I'm not wrong. 23 and 24, right? Hello guys, take a look at your classwork. Are we left with two questions? Yes, 23 and 24, correct? Okay. See, you must have noted that in this chapter, I made you practically run through the whole book at a different sequence. Okay, after we complete these two sums, the chapter's classwork would be over. Okay, this chapter strongly recommended that you revise from notebook sequence only. Correct? If you open a textbook and start with question number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, huh, it will be bounced. Correct, Kukal, it will be totally bounced. Not even on the pitch. Forget about doing bounce. Huh, much at a different level, right? It's like you're batting in Delhi and the ball is in Punjab. Yeah, it happens no Zoom also. Okay, students log in with the wrong IDs. They're waiting. When sir will start lecture? Right? They message the office. Okay, yesterday, like one of the students was messaging the office. 5 o'clock, 5:10, 5:15. When the lecture will start? Right, dead. Holiday is declared. You're still waiting for the lecture. You don't know. You don't read the messages. So that should not happen, guys. If you follow the classwork text sequence from the textbook, so see, if you're thorough with all the concepts, you can solve any sum. But if you're revising the chapter as a whole, then you should follow the notebook sequence, right? Okay, fine. So time to start with question number 23. Let's go here. The two forms P and Q are identical, except P does not use any debt. Okay, so when we say that P does not use any debt, that means P becomes what? P becomes unlevered. Okay, while Q has 8 lakh 9% debentures. Okay, that means Q becomes what? Levered. Okay, friends. Both the firms have earning before interest and tax of 260. See guys, their EBIT is same, right? So invitation to right? The EBIT is same, so it's an invitation to MM is saying, see, you now you have to follow my approach. Okay. And capitalization rate is 10%. Assuming corporate tax of 30%, calculate the value of these firms according to Okay. So what says Let's see. Hmm. See. According to hypothesis. First, we'll find market value of P Limited. P Limited is what? Unlevered. Okay. Let me open the question. EBIT is 2,60,000, right? Earning before interest and taxes, how much? 2,60,000. Now that interest is nil, now obviously it's an unlevered company. So EBT will also be 2,60,000, but there will be tax of 30%, guys. So 260 into 30% makes it to 78,000. Okay, less you get 1,82,000. Then you know now tax is introduced, but rest of the assumption remains same. No preference capital, no retention. So this itself will become our dividend. So what will be E? E would be dividend upon K. Dividend is 1,82,000. Capitalization rate given in the question is 10%. 10% means 0.10. So what will be our final value of equity? Our final value of equity or value of the this will be 18,20,000. Okay, friends. Now you all know that there is no debt, right? So value of the firm, which is debt plus equity. Debt is nil. It's an unlevered company. Debt is nil plus 1820. So obviously value will be 1820 only. Okay. But sir, you taught us this formula. Sir, see, it happens sometimes like this, that when you follow certain things, obviously the second thought has to crop, and it's good that it crops in mind. And see, it should get resolved on the spot, right? You should not keep that pending. I said you must have noted that, okay, I think like you, okay, what if this, what if that? So automatically we are at ease. Okay, fine, sir, you dot this formula also. V is equal to what? EBIT upon KO. And if taxes exist, to that EBIT will multiply by 1 minus 2. Do it. Do it. Okay. So EBIT is how much? 2,60,000 into 1 minus 0.3. KO is 0.10. You're going to reach the same level, guys. You're going to get the same answer. 260 into 1 minus 0.3 means only that net value 182. You can always check on your calculator, guys, so you get the same thing. Upon 0.10. Answer is that only, guys. 18,20,000. Okay. Now, what will happen to the value of the levered form? It will be value of the unlevered form plus one, plus that benefit because of taking a loan. How much is the debt that they are taking? They are taking a debt of 23. They're taking a debt of 8 lakh into what is the tax rate prescribed in question? 30%, 0.3. 18 lakh 20,000 plus 240. 20 lakh 60,000. That's it. That is what is asked. Value of the levered form and value of the unlevered form. Done, people. You done writing? Not yet. Photography. Sushma. Actually, you write everything at the end. You write, huh? But no problem. Both options are okay. If you leave pages and write right now, or you leave pages and take photography only, that anything is fine. But complete your notebook. Ashriya, done or not? Done. So shall I move to the next question, Ashriya? And everyone else, huh? Because Ashriya I could see telling me to stop. Otherwise, I don't know. Yes, Ramya, you are done. Photography happening or writing? Ukal done? Huh? Okay. Okay, fine. Let's go ahead, people. So now we'll come to the next question. Come to question number 24. Okay, let's read it. RES Limited is an all equity finance company. Is what? All equity finance company. That means only this RES unlevered company with a market value of 25 lakh. Guys, if it's an unlevered company, then V has to be equal to E. No? You understand? Value of the firm will be value of equity. Debt is zero. Na? Debt is zero. Okay, fine. And cost of equity is 21%. Okay. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. Oops. Means once the debt is issued, what will happen? Same RES Limited will become levered company. First, you need to understand this. Initially, now there are no two companies like last question. In last question, there were two companies, P Limited separate, Q Limited separate. One of them was levered, one of them was unlevered. What is happening right now? RES Limited itself is initially unlevered. What they're planning to do, they're planning to redeem some shares and issue debt. So in the capital structure, they are making a change, and the same RES Limited itself will become levered company now. Is that understood? There are no two different companies. The same company earlier, it was unlevered. Now it is planning to become levered. Okay. Rate of tax may be taken as how much? 30%. After the capital restructuring and applying MM model with the taxes required to calculate market value of RES. This is, guys, all what after restructuring. Now pay attention to the word. Otherwise, you will tell me, sir, market will be given, sir, 25 lakh. Hey, hello, that 25 lakh is of which company? Levered or unlevered? Unlevered. That 25 lakh is of unlevered. And what they are asking you to do is after restructuring, that is after the debt is issued, after there is a restructuring in the capital, then you've been asked for market value of RES again. Then you are asked for cost of equity again. Now, sometimes, people who are in half sleep, they tell me, sir, everything is given only there. Everything there, sir, you only mark, sir. Cost of equity 21%, sir. Value 25 lakh. Hey, my dear, then I have to make them aware. Hey, my dear friend, that is before restructuring, right? The 25 lakh you see, 21% you see, is of the RES Limited unlevered. You have to find for RES Limited, which is levered after capital restructuring. And also find what? weighted average cost of capital and comment on it. Okay, fine. So let's start. Okay, let's start one by one. See, also all methods I will show. Yes, solution to classwork 24. Okay, how much is the value? Tell me. The value is 25 lakh. Correct. See, it is unlevered firm, guys. So V is equal to E because that is nil. KE is equal to KO because there is no other source of finance. So that's what we are doing. We are saying KE is equal to KO. And then what is the formula for KO? EBIT upon V multiplied by 1 minus T. Tax rate is there. KO, you put how much? 21%. EBIT, EBIT is what is not given in the question. Is. Did you notice that EBIT is not given? So you solve this, you get an EBIT of 7,50,000. Any alternate method? Yes, why not? Alternate methods are always there. Sir, we want to go with the formula of K. Okay, you are welcome. KE is equal to what? Dividend upon E? Yes, sir. KE, you put 21%. Equity, you put 25. Solve it. You will get a dividend of 525. Go in the statement. Na? EBIT minus interest is EBT. EBT minus tax is what? Dividend, because of preferential shares, etc. So this 525 we know. Now see, if this is 100, this is 70. I'm sorry. If this is 100, this is 30, then this is 70. We know this amount. Can we cross multiply and find the other amounts? Yes, why not? 525 divided by 70. Whatever comes into 30, 225. Add it back, guys. Add it back. Or you just do into 100. You will get the 750. Interest is nil. It's an unlevered company. So EBIT is 7,50,000. See, again, I have shown you two methods, guys. Did you realize these are two different methods of getting the same thing? Right? Either go this way or go this way. Your ultimate EBIT is coming same. 7,50,000. Correct? Okay, but sir, we are not asked for that. Yes, obviously, we are not asked for that, but that is required as an input when we solve. Okay, let's talk about RES Limited levered. Okay, let's talk about what? RES Limited levered. This is the background work that we have done. Okay, first you tell me now whether the firm is unlevered or levered. Will EBIT change? That's an important thing to understand. Just I bring debt in my capital structure, remove some equity. Will my sales change? Will my variable cost change? Contribution, fixed cost, anything is going to change. So that part of the income statement will remain same. So EBIT will remain same. So whatever is the EBIT of unlevered company, RES Limited unlevered, can I say will be the same EBIT will be there for RES Limited levered? Okay, now we are worth going for this. Now you must have understood why we have calculated this EBIT. So see, RES Limited to issue 5 lakh 15% perpetual debt. Very important to understand. EBIT will remain same irrespective of what change in the capital structure. Correct? This is the most important part, guys. Copy EBIT is the most important part. Copy EBIT, I mean to say that EBIT remains same. Then only you will have a scope to proceed further. Okay, see the income statement. I copied the EBIT of 750. But now companies want to take 5 lakh 15% debt. So 5 lakhs 15% came to 75,000. So 75,000 will be subtracted from this 750 minus 75,000. 6 lakh 75,000 is left. Okay. From this, there's a tax of 30%, right? Into 30% comes to 202,500. Right? So the dividend comes to 4 lakh 22,500. Done, friends. I hope you understood till here. I'll reduce it for a moment so that if you are writing, those who are writing can write, those who are taking screenshots can screenshots. Done. Okay. One last time I'm asking, guys. Those who are writing, are you done? Mahalakshmi is still writing. What happened, Ashreya? Are you done? Huh? Achha, now photograph. Idea changed. Okay, okay, no problem. So now, see, market value of levered firm would be simple. Market value of unlevered firm plus what? Debt into tax. What is the value of unlevered firm, guys? Unlevered firm's value is 25 lakh. Correct? Right? Debt is how much? 5 lakh. 30% of that. So 150. So total would be 2650. So we are answering the questions one by one, right? The first question asked is that only. See, after restructuring, you are read the question. After restructuring, you are required to calculate number one, market value of RES Limited levered. So we have answered the first question. We have answered the first question over here. Market value of RES Limited levered is this much. Okay. Now talking about the second question, you will ask for what? Calculation of K. Okay, fine. Now, sir, K is very simple, sir. Dividend upon E. Yes, absolutely right. For that, we just need to understand one thing, guys. See, what market value of levered form we will calculate it just now. 26 lakh 50,000. This one, guys, this one. I'm just getting the breakup of that 26 lakh 50,000. Just getting the breakup of that 26 lakh 50,000. What I know for sure that my new debt is how much? My debt is 5 lakh. Okay, I'm going to buy back some equity, na? So equity's market value will reduce. So debt is 5 lakh and the total market value is 2650, right? So value of the equity will be how much? 2150. This is important to understand. Okay, people see, you know what people think like this. Sir, earlier 25 lakh, no? Issued 5 lakh of debt. So 20 of equity now and 5 of debt now. No, no, no. There's a tax saving, guys. Debt plus tax rate. Debt plus tax rate, no, sorry. Debt into tax rate, there's some tax savings. So it is not exactly 20 and 5. The remaining equity values increases. It becomes 2150 and not 20 lakh. That's why the value of the firm is 2650, as you can see on the screen. Out of that, 5 lakh goes to debt, and the balance 2150 becomes the market value of equity because they are enjoying some tax benefit. It is not exactly the same as book value. The market value is slightly higher at 2150. Is that understood? So here now I can put dividend as how much we just now calculated, no? 472 500. And equity value we got how much? 21 lakh 50,000. It comes to point. Okay, let me write it. It's 0.21976. So I'll make it 2198. That is 21.98%. Okay. Then coming to the last point. What is that? Calculate weighted average cost of capital and comment on it. Weighted average cost of capital means only what? KO, na? Right? So what is an option to calculate KO? Simple, sir. EBIT into 1 minus T multiplied upon V. Yes, correct. EBIT is, we know, 7 lakh 50. Let me calculate. EBIT is what? 750. 1 minus tax divided by V. What is the value of this? What is the value of this levered company? 2650. Let's calculate that. 750 into 0.7 divided by 2650. 1981.1981. That is 19.81%. Yes, people. Now, some people are going to tell me, sir, but when you said KO, no, when you say KO, no, sir, I remember that source, cost, amount, product. Can't we get it that way, sir? Because see, if you write the formula, then it should come by all means, no? Then we feel satisfied, sir. You teach some formulae in capital structure theory is fine. But earlier we learned this way, na, sir? KO we learned this way. So it should come this way also. When did I deny that? If it can come this way, it can come by our old formula also, older setup also. Let's do that. Okay, but for that, no, what I will do, I'll have to first calculate this. Okay, what are my sources? My source is debt and equity. Amount I know. Debt is 5 lakh. Equity is 21 lakh 50. Guys, whatever I've written for amount, do you agree? Market value, market value. Debt's market value is 5 lakh and equity's market value is 2150. You agree on this? Okay, fine. Cost. Equity we just now found, no? 19.81. Correct? In debt we will have to find. Debt we will have to find. See what is written in the question. If you read the question, it is very clearly written that a debt is a perpetual debt. Correct? And even if it is not written that it's a perpetual debt, anywhere redemption details are given, not given. So tell me, small or large? Formula, small formula. Remember, na? N is not given. Okay, fine. So before I conclude this, as usual, we'll leave the space for the conclusion over here. Let KO is what? Total product upon total weights. I think weights we can write now. Amount itself is our weights, no? 2650. This is what we know now. Okay, now fine. Now whatever we know, we will write 2650. Okay, fine. So to proceed further, what we will have to do? We'll have to calculate KD. KD would be what? Interest 1 minus T upon net proceeds. Okay. What is the rate of interest on the loan that company is taking? It's 15% loan of 5 lakh, right? So 15% of 5 lakh into 1 minus 0.3. Correct? Tax rate is 30%. 30%, right? Divided by net proceeds 5 lakh. It's a loan, no market value, same thing. Okay, so 15% of 5 lakh, 15% becomes 75,000 multiplied by 0.7, 52,500. Divided by 5 into 0.105, 10.5%. Okay, so now over here in KD, I can put 10.5. Now you know now what to do, just multiply. So 10.5 into 5 lakh, 52 lakh 50,000. And then 19.81. I'm just sorry. KE is 21.98. I by mistake wrote. This is KO. This is KO. KE is 21.90. We found it over here, sir. So over here you write 21.90. No? Sorry. Yeah. So 21.98 into 2150, 4 crore 72 lakh 57,000. This comes to 5 crore 25 lakh 7,000. Okay, 5 crore 25 lakh 7,000 divided by 2650. Oops, it came same. 19.81%, guys. Right, so whether this way or this way, it is coming same. I'll shoot from the beginning, huh? Those who are taking screenshot. Question number 24. Those who are taking screenshot, should I scroll further? Is that done? Okay. Done, people? Okay. That's it. So this question complete. So I hope you understood this part. Okay. Yeah, just sorry, I forgot to write the comment. You have to comment also. No? What is our earlier? What is our earlier KO? Earlier KO was 21%. Right? Now KE itself was KO. Now what has happened? It has gone down to how much? 19.81. Okay. So what comment we will offer? Comment on KO. What we will say? KO has reduced from 21% to 19.81%. Probably what due to benefits of tax saving. Correct. No other reason. No other reason. Okay, people, fine. Let's move ahead. So now all the questions in classwork are over, right? We will take a quick look from the questions of sections to be discussed in classroom, right? And then we will move further, right? I plan to introduce the next topic in this series. That is what capital budgeting. Okay, I'm going to introduce that, but before that, we'll take a quick look at the questions to be discussed in class. They are very easy. They're very easy, not like other. They are very much similar to the questions that we have already done. Okay, let's take a look at this question. See, guys, such a plain question. Equity share capital is given 65 lakh. 12% preferential capital is given 12 lakh. 15% redeemable debentures are there and 10% convertible debentures are there. They are so sweet. Cost of equity capital is given ready-made to you. So I can say KE is available, correct? Okay. Tax rate is given. See, for preferential capital, nothing is going to change. KE is how much? 16.3. What about KP? KP will be 12% only. If there is no separate market value given, you solve it. Put into the formula preference dividend in divided by net proceeds. Preference dividend will be 12% of 12 lakh divided by 12 lakh. Ultimately, it will be 12% only. Okay. Here you calculate KD, interest 1 minus T upon net proceeds. Same way you do over here. Okay. Take these as what? These as only what? Weights. You're required to calculate WCC. That's it. As usual, you write source. Then this cost amount. What will you write in amount? 65 lakh, 12 lakh, 20 lakh. That's it. Fine. See, question number 2, you see. From the following capital structure, calculate the overall cost of capital using what? Book value weights and what? Market value weights. They are so nice. They see when you see this in book value, they are giving you weight of this amount of equity, amount of retained earnings, amount of preference, and amount of debentures. In market value, they don't want you to make any mistake. They're not giving you any amount of retained earnings only. You know why, guys? You remember the basic assumption that the market value of equity is assumed to be including the market valuation of reserves. Correct? Right? Okay, so fine. Once you take these as weights, and see, they don't want you to trouble much. So K is ready-made given. Such caring people. See, guys, in this cruel world, where will you find people like us who are so caring? We've given you everything. Just you have to multiply and get the numbers, right? Okay, K is given, KP is given, KD is given. So KR is not given. Who's asking that KR is not given? I will give you the KR. Why needed? Are Pukal needed? No, for book value weights. But it will stream, no. If K is 14%, hey, somebody back into picture. Hi, somebody, good morning. It will be 14%. Correct. It will be same. K equal to KR. So I hope you can manage this question. You'll have to solve it 2 times. Once book value weights, once with market value weights. Next one. Cervix company has the following capital structure. Ordinary shares, guys, ordinary shares, equity shares. I'm always scared that student will one day ask me, so if these are ordinary, then who's extraordinary? They're only ordinary shares. Okay, ordinary shares are extraordinary, actually speaking. Then preference shares over here. And debentures over here. 80 lakh is the total, guys. Check for yourself. 40 plus 10 plus 30. Refractive index. Refraction has happened. The share of the company sells for 20 rupees. P0. Expected that the company will pay 2 rupees dividend next year, guys. Oh, what? D0 or D1? D1, 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 right? Everybody understands that. Next year, no, so D1, yes. Which will grow at 7%. Growth 0.07 and tax rate is 0. I think, guys, the things which we are written P0, D1, and G. Is this enough for calculating K? What's it? Enough, na? Sufficient. Now, those three numbers you put, K would be there. Okay, fine. Okay, sir, but what about the details of others, sir? Preferences and debentures. Are that you put the formula, no? Okay. Compute weighted average cost of capital based on what existing capital structure. So in the amount column, you will copy 40, 10, 30. KE we will calculate. KP will be, see, you calculate, it will come 10% only. 10% of preference capital divided by preference capital. And debentures, what is the thing? Tax rate would be there, guys. Okay, so interest into 1 minus step 1, that proceeds. Okay, separate question. Part B. Compute the new weighted average cost of capital if the company raises additional 20 lakh by issuing 15% debentures. Now, what will happen, guys? Earlier, you were having three sources. 1, 2, 3. Okay. New weighted average cost when you calculate, no? So in source, you will have four sources. 1, 2, 3 older plus this fourth one. 15% debt. Okay. But see what is going to happen. This will result in increase the expected dividend of 3. People, new D1 is given. Growth rate is same, but the price will become 15. So P0 is 15. Growth rate is same as growth rate is 0.07. What you will have to do? Tell me again. New KE will come. New KE. Get it? When you calculate all this again, what will happen, guys? Let's say this is equity shares. This is 10% preference. This is 14% debentures. What will happen? This all would be same. This all would be same. But when you will calculate over here, no, for equity shares you calculate, no, you will have new K with these new numbers. This all would be same. Excuse me. Did you understand that? Sure. One more option C is there. They are gone crazy. They want you to keep calculating this again and again. What is written in point? See, compute the cost of capital in B above. If the growth rate increases to 10%, again new K. Put D1 as 3, P0 as 15 only. But now earlier you were to take growth as 7. Now you will take growth as 10. Now what will happen? This 10% preference, 14% debentures, 15% debt. Everything will remain same. Only the equity you will have to put new KO, new value of equity, K. Did you understand? All permutation combinations are happening. You solve, you will understand. Very easy. Only few places new KE is to be calculated. That's it. Okay. Manageable. Question 4. XYZ Limited is expecting an EBIT of 3 lakh. Company presently raised its entire funds of 20 lakh by issue of equity. Oh, my capitalization of 16%. Okay. The firm is now contemplating to redeem a part of capital by introducing debt. The firm has two options: to raise debt to the extent of 30% and to raise debt to the extent of 50%. Okay, fine. See, I'll put like this. Okay. See what happens. If it is expected that for debt financing up to 30%, rate of interest will be 10%. So I can say KD is going to be 10%, right? And the equity capitalization is 17%. So KE is going to be 17%. If the firm opts for 50% debt, then this interest will become 12% and equity capitalization will become 20%. You are required to compute the value of the firm. Value of the firm is V and its overall cost of capital means K O. Use traditional approach. Basically, guys, what you will have to do? Capital structure theory means those formulae will come into the picture, right? How we will calculate? See, I think this is a similar question. We have to calculate value and we have to calculate K. You remember how we have done a reverse thinking, right? So value is equal to what? Value is equal to debt plus equity. And KO is equal to what? KO is equal to EBIT upon B, right? So first what you do? You do EBIT minus interest. EBIT minus interest will give you dividend. Dividend is there. K. Okay, I'll write. See, first we'll do EBIT minus interest. That will give you dividend, correct? Then dividend is there. K is given in question, guys. You can therefore E would be equal to what? Dividend upon K. So earlier you knew dividend. Now you know E. Fine. Okay. Now how you will proceed further? Therefore, V is equal to what? Debt plus equity. Debt will be given in the question, certain percentage of 20 lakh plus the value of equity that you have found. Now you know the value, then you can calculate. Then you can calculate what? KO. What would be KO? KO would be what? EBIT given in question upon the whatever you have calculated. This is the sequence of solving this. You remember, guys, yesterday also I gave you a sequence of solving. Same sequence you're following. Actually, no different thing is happening. Sequence is also same. Done, people. Homework sections are all similar. Go through it. No different thing. They're all from the questions that we've already solved. Okay, solve it. Take your time. If you don't understand or you have a doubt, you can always ask me in doubt solving session. Yeah. Okay. So now we are. Should I show it again? Ah. Now, next thing that we are going to talk about the next topic is about capital budget. You remember this, guys? We had done this on the first day. When we first day means not of the whole lecture series. First day of this topic, cost of capital. Then we had discussed this once again that okay, aim of the finance manager is maximization of wealth of equity shareholder. That is maximization of MPS. Okay, maximization of EPS. How it can be achieved? So before starting this topic, we had discussed the capital structure, right? Yes, sir. Arrange the capital structure efficiently so that what happens? EPS increases. What is another way? Raise the funds at lowest cost, invest it at the maximum profit, guys. So investing the funds for maximum profit where returns are higher than cost, to invest the funds in the most profitable manner, what we will learn? We will learn capital budgeting. Okay. See, just now what we have completed is the cost of capital.